welcome to Economic Impact. Today is September 10, 2024, and as usual, I am with our Chief Economist, Stéphane Marion. Good morning, Stéphane.
Good morning, Denis.
So, since the last time, we see the performance from the asset classes being a bit different since the last time.
Since last time we saw each other was in July, at the beginning of Q3, right? All asset classes were rising. We were arguing for potential volatility, and now near the end of Q3, we can see this volatility has actually occurred, or more dispersion, I should say, with respect to the total returns of different asset classes. Note that the S&P TSX was really trailing behind all the other equity indices, actually leading in the third quarter, but followed by the bond market. And maybe the biggest difference, Denis, is the underperformance or lack of performance, negative performance from the S&P 500. So that's a big change from the start of the third quarter.
And because of that, we saw the volatility increasing quite a lot.
Well, yeah, the negative return was triggered by a surge in volatility in August. Note on this slide that if you exclude the pandemic episode, we haven't seen volatility VIX at 40 since 2015, so about a decade, 9 years. And that means, Denis, that people are now second guessing what the actual outlook will be like. I would just remind you that at this point in time, there's still 80% of investors that are bidding on a economic soft landing for the US. We'll see what happens, but clearly there are some investors saying, well, maybe things are not so clear-cut going forward.
Yeah, and having the Fed not decreasing rates makes that volatility is getting higher and higher because, people are expecting those rates going down and they're not coming down.
Yeah, do you know how long it's been since the Fed last cut rates, Denis?
Long time.
Well, since their last rate hike, it's been now 12 months.
12 months.
Historically, that's very, very long because on average, the Fed will cut rates 7 months after its last rate hike. Now, it's been a year. We're going to get one probably in September. But note on this slide what the big difference is between this time around and previous cycle is that the unemployment rate is up almost a full percentage point, well, 0.7 percentage point, which is much bigger in terms of amplitude than what you normally see a typical cycle, which is the blue line on this slide.
Is it what we call the SAM rules?
If you want to speak to economics jargon on that one, okay, fine. I'll summarize what the SAM rule is. I'll simplify it. Normally, when the unemployment rate rises a half percentage point above its cyclical low, you trigger what you call the SAM rule, and historically it's been associated with a significant slowdown of the economy and more often than not a recession. So the SAM rule was actually triggered last July, which brought this volatility that we got in August on the stock market. Now, as I said before, most people still believe all the SAM rule is misleading us this time around. Maybe the soft landing is still the typical outcome because even the Fed argues that they can achieve a soft landing despite being very late in the game in terms of cutting rates.
And despite the fact that the Fed are not, moving down on their rates, global inflation is still creeping down. Now,
I will concede that the Fed is able to cut rates now, and maybe they will be able to cut rates aggressively because inflation is coming down. As you can attest on this slide, it's a global phenomenon. It's not just the Fed that will be cutting rates. It's a whole bunch of central banks. And under these circumstances, if it's a synchronized easing cycle, people believe that there you go. You're going to get this economic soft landing and earnings won't be impacted negatively.
And at the same time, we're seeing the economy cooling. That means that earnings revision may come.
Inflation does not come down by magic, Denis. So basically what that means is that for inflation to come down, you have to get slow economic growth. And if you get slower economic growth and you keep monetary policy restrictive, you can get an accident, at some point in time. And as you'll see on this slide, the blue line shows that global manufacturing activity is now contracting again. And historically, this has been associated with downward earnings revision. So again, the market is priced for perfection right now because you're trading at high multiples, and the assumption is that mission accomplished by the central banks. You'll get this economic soft landing and no impact on earnings. But I think a negative impact is coming if you can gauge on historical relationship between activity and earnings revision.
But then earning growth expectation will have to come down because right now they're still pretty high.
Yeah, and remember we spoke to this back in July and say, listen, this is a bit high. It was expectations of 14% over the next 12 months. It's been revised a little bit down, but you're still expecting 12%. That's the red zone or pink zone on this slide. 12%, earnings per share growth globally. But note that every region of the world is showing a positive uptrend on earnings, despite the fact that monetary policy remains restrictive. So we're going to get these rate cuts, Denis, but monetary policy is not becoming accommodative anytime soon. So you're going to get below potential growth, which I think will impact earnings.
More to come then on that front.
I think so, yeah.
Okay. If we come back to Canada, then GDP still pretty high, but personal consumption are not there.
Yeah, so if you focus on GDP, you'll say, it was better outcome than expected, but that's because government accounted for 50% of growth in the second quarter. If you look at consumer spending, the red line on this slide is pretty anemic, Denis. So, and that's impressive when you consider that population growth continues to surge in 2024. So to get a surge in population growth and only 0.6% growth in consumption means that your economy is not performing very well. So things are not better than elsewhere in Canada. It's a pretty tame GDP outcome in Q2.
Would you say that at this time, even if the Bank of Canada lower rate, before the Fed, they're not lowering fast enough to bring the consumption back?
It's a good question. I mean, the reason consumer spending is so weak is because households must devote 25% of wage increases to servicing their debt because interest rates are much higher than they were a few years ago. So considering all that, considering that inflation's coming down, there's going to be rate cuts. But at the end of the day, what you can see on this slide is that despite the fact that the Bank of Canada has cut rates already twice, the policy rate adjusted for inflation is barely coming down. So monetary policy remains the most restrictive since 2006. Denis, what that means is expect slower growth in Canada and a higher unemployment rate, which will probably lead the Bank of Canada to accelerate the pace of rate cuts in the coming weeks. So yes, there will be collateral damage to the Canadian economy in the coming weeks. But the good news, inflation's coming down. They can cut rates aggressively, but there's still going to be an impact on earnings in Canada, as there will be a negative impact elsewhere in the world.
Would you say that the Bank of Canada don't cut rate as much as they should because of the Fed not starting to do so?
You're right that they were probably a little bit shy or of going more aggressively, but probably concerns about the Canadian dollar. But at this point in time, U.S. dollar has been weak, so Canadian dollar has held its ground. So I think that opens the door for more aggressive rate cuts in Canada. Actually, our fixed income strategists recently published their monthly, and we're showing an acceleration of the pace of rate cuts from a Canadian perspective in the months ahead.
Okay, now we said all of that. What do you expect has a return from different asset classes?
So investment conclusion, right? So, well, Denis, if you trigger the SAM rule, I'm sorry, historically, it's not good for risk assets. So historically, 3 months following the triggering of the SAM rule, and note that this is one of the first times the Fed has not even cut rates, despite the triggering of the SAM rule, you can see that the stock market, whether it's the US or Canada, it's down about 9%. The only asset classes that play a defensive role would be gold prices and the US dollar. Gold because of more volatility, the US dollar because more risk-off environment, and clearly the bond market is also somewhere to hide. So investment conclusion, Denis, I think there's going to be more volatility this fall as people reassess their earnings expectation. So it's time to play a bit more defensive in our opinion, and those U.S. elections coming up with uncertainty about policies, keep that in mind also.
Well, thank you, Stéphane, and thank you for being with us today. And above all, we expect to be with you next month, beginning of October. Have a good day. Thank you.